We are here at Right Choice Happenings Realty with Steve Dainard, mortgage broker with Mortgage Architects.
Right.
And thank you so much for joining me here.
Yeah, my pleasure. Thanks for having me.
Pleasure is mine. Steve, it's been a little bit since we've done a deal, but we have done some deals in the past.
Right.
And one of the reasons I thank you for coming, because I asked and you said yes. One of the reasons I want to have you is just because the business we have done together, I was really impressed. You definitely know how to problem solve.
Right.
Look at the angles. And I was impressed with the work we've done.
Awesome. Well, I appreciate that. I think when you're in, a service space, it's really critical to make sure that not only the clients you're serving, but your referral partners are also, happy, because we're an extension of, your client base, right? So I take that very, seriously, and we try to do the best we can.
Yeah, I like it. I like it. And I don't know if you remember, but one of the deals we did a long time ago is I think it's the only time that I worked with somebody purchasing a property using the Aboriginal or Indigenous grant.
Yes. Yeah, I remember that. Yeah.
Yeah. And actually since then, was it this year or last year, we helped them sell the property and they actually moved to the reserve, which is great.
Yeah.
Back. But I remember that we had to do a lot of problem solving through that one.
Well, they reached out to me, when that was all going down, and they're like, "Hey, is there an impact to, the grant process?" So I did have a bit of a consultation with that. So it was a definitely unique, deal, but what a great learning opportunity, and this fantastic people as well.
Yeah, that was a good one, and it's interesting too because I've already had 2 mortgage brokers on podcasts in the last few months or whatever,
Sure.
And everybody has different perspectives. It's funny when some of the conversations that it sparked with talking to some people, and some people don't realize how professionals within industries are not all the same.
Right.
Better, worse, different.
Right.
And that's why, myself, the first mortgage broker I had on is Sherry Vina, who we do a lot of work with.
She's a super nice lady.
Yeah, she's great. And when I was at Century 21, she's part of Centum, and we've done a lot of our work together. And then I had Cam Wilson on, done some business with him.
Yep.
But
he's a good guy too.
Yeah. And
love his perspective, his market insights. He's a really sharp guy.
Yeah. And he looks at things differently.
Yep.
And the conversations I've had with people is I didn't realize how different mortgage brokers could be. And I'm like, this is mortgage brokers, realtors, I'm like doctors, teachers, just because you're in a profession doesn't mean
you're all the same.
Yeah, not even.
Right.
And I think a good thing that we can maybe start off talking about, and I'm happy to start, is how much different this year was in real estate than previous years.
Right.
You've been doing...
So I've been a broker for just over 10 years now. I'm going to my 11th year.
Right.
It's a second career for me, so I have a government, background for 30 years. So that transition into the entrepreneurial space was a bit of, of a wake up call, but in a good way,
Right.
Even when I worked for the government, I kind of thought I was more like what you call an entrepreneur. I always had that entrepreneurial mindset, and I kind of did my job within the constraints of government structure for that. So I love this space. I love what we do.
Yeah. Interesting. Yeah. I remember that you had something before. Do you mind? I can't quite remember what you're doing within the government before.
Yeah, so I was a manager for finance and administration, with the Toronto Transit Commission, 30 years. And
30 years.
And we had moved down to Niagara about 2.5 years before I actually retired. But as I was getting into 2013, I was kind of like, what am I going to be doing? I can retire, next year, and I'm young. I'm 49. I got my whole life ahead of me. What am I going to do? So mortgage brokering kind of literally fell on my lap, and everything happens for a reason. And like I say, shoulda, coulda, woulda. I don't lead my life like that, but I wish I had got in the space when I was in my 20s.
Yeah?
Yeah, for sure.
Yeah, no doubt. But I'm sure your 30 years and previous experiences, when you came in, because we started about the same time,
right.
I started about 10 years ago.
Yeah.
I was always impressed with just you being able to figure things out.
So, what I love about this is even when I worked, with my previous employer, my other career, I was always a problem solver. People would come to me, and I think what happens is that, maybe there's a bit of an insecurity there. I want to make sure I'm as competent as I can be because I recognize that people, will come to me and seek advice, right? So I think that's why I love what I do so much now. So I want to make sure that I'm up to date as I can be, and that you're also providing solutions for people so that you can take that pressure off of them, because bearing your soul around your past potential credit indiscretions, if that's the case, that's a lot to have a conversation with somebody about, especially if you don't have a really robust conversation. For the longest time, I was always like, oh, well, how come my family members aren't using me for their mortgage? You know what I mean? But it was really that, once they realized we were in the space and we weren't going away, that conversation changed because, it changes the dialogue with them as well. And that's why I think I really love the problem solving aspect of what we do. And I don't always get it right. Sometimes, you have to have a hard conversation and say, I've done everything I can, and there's really nothing for you right now. And to your point earlier, the market has been so different, especially the last 18 months. That is a lot of people's reality right now. You know, wages have not increased the same that, interest rates have been. And, and people are getting some debt, kind of going on. And they're really, they're scared. They're not sure what the next steps are going to be like. A lot of the conversations now, because volumes are down, transactions are down, not only in the mortgage space, but also in the real estate space.
Totally.
What's happening is that, we're saying to people, listen, this might be your approach. So a lot of consultations about setting people up for success on maturity of their mortgages. Statistically, 60% of 5-year term mortgages are coming up for maturity in second half of 2024 into 2026. 60% of all 5-year term mortgages. That's going to be
in Ontario or Canada? Or?
Canada.
Wow.
That's going to be a big conversation.
Oh, that much?
It's huge. Because think about it, okay? Let's go back, 5 years from 2024. We're in that, 2019, 2020. Rates were really low. People were doing a lot of transactions. Now they're at the end of that maturity cycle and they're like, what are we going to do? So there's a lot of conversations.
How can it be that high?
60% of all 5-year terms, not of all mortgages, of all 5-year terms. Yeah.
Okay.
Which, lenders price the 5-year term at the most, but realistically, it's the best rate you can get historically, okay? Because, they're going to make a decent amount of money on that book of business for a 5-year term compared to a shorter term. So those are the ones that have a tendency, when the market's balanced, economic outlook is decent, to be the most popular. Okay. And I think too, from a consumer perspective, it gives people enough time to, make a dent on the mortgage balance and move forward without having to be a 1 or 2-year term. Right. So, and when rates were low, everyone was opting for 5-year terms, unless you had a specific reason why you need something less than 5 years. We're relocating in 2 years. We're going to have to, get a larger house because we're planning on having children, whatever that looks like. So those are more of the exceptions than the norm. Right. So there's going to be a lot of conversations happening, and people are afraid. They're like, am I going to qualify for, the new mortgage with interest rates being significantly 3 times plus higher than what they were when I got this mortgage 5 years ago? What's that going to do to my payment? So those are harsh cash flow realities, right?
So there's a couple of things I want to get into with that being said is, first, some advice we can give to people with that. And also I want to touch on different advices that you can give to people. But even before that, I'm not sure where everybody's at, but let's just talk a little bit about the state of the market to help preface it a little bit. And I'll start with, from my perspective, like I've been doing it almost the same time as you, 10 years, 11 years for you. Back then it was a buyer's market. It was really flat. I think back then when I started, correct me if I'm wrong, interest was maybe in the 4s. Do you remember?
So it probably could have been maybe the high 3s, 3.79, 3.69. My gut's telling me it was kind of, pushing that 4% mark for sure.
Yeah, around there. And market was flat, where I was seeing an appreciation similar in Niagara, like across the nation, where it was around 3% appreciation a year, where, we've seen more than that per month. But we seen that up until, I don't know how many years ago it was, 5-ish or so, when we kind of transitioned from a buyer's market. It didn't seem like it was balanced for too long. And then we hit a seller's market where the market was on fire.
Right.
And then we hit COVID and the market got even hotter.
Right.
And then interest rates started going up. And then we started seeing the market cool down a lot. And
So you recall, Joe, that
yeah,
in 2017, Niagara actually went through a market correction. And what was happening is that houses on general went up about $100,000 per unit, almost, overnight.
right.
And what a lot of that was Toronto buyers seeing the value of the Niagara market. It's not that far away from the GTA, and they have money to spend. So we did see, and that's that first little upward trend you're talking about. It was completely a seller's market, and that was because generally across the board, properties went up about $100,000 on average. And at that time, the properties were like $300,000 and change, on average. All of a sudden, they jumped to about $400,000 on average, right? And so that was the first opportunity that came along, and people were just like, "Oh, there's no inventory, and there's lots of buyers." And
Right.
I had a lead gen thing, that I was working on with some real estate agents about. I hired a Facebook manager and a virtual assistant, and in January of 2017 to March of 2017, generated about 1,900 leads.
Wow.
Through that for a few realtors that I was working with. And so what came about, though, as we went into that April to May of 2017, what happened is that the majority of the leads were buyers, and there was no inventory. And a lot of the real estate agents had a lot of buyers. They needed listings. Right.
Which we have a lot of now.
Right. So, so at some point, my wish is that we get to a balanced market, where
Balanced
ideally,
market's the best, but it's so
when was
tough.
the last time we had one of those?
I don't know. Like I said, I remember we went through one and it didn't feel like for long.
Right. Short-lived, right?
And we're in a very interesting market now too, because I thought for a period of time I'd seen everything, because there's 3 kinds of markets: buyers, balanced, and sellers. So I started in a buyer's market, had seen a balanced, and then a seller's. And now it's got to be a buyer's market. It's been a while since I've looked at the numbers because you determine it different ways.
Sure.
Even though there's still, right now, properties that are going into competition and having multiple offers, which I don't remember that happening 10 years ago. I didn't see that for years. So there's still little hints of that. But the difference...
But that's not across the board, though, right?
No, it's not on every property.
Yeah.
It just happens like we have... From the 10 or so listings we have right now, we have one property that went into competition twice, but even still, it was only 2 or 3 offers each time.
Sure.
And it was, and it's not even sold because the offers were conditional.
Right.
And they fell apart. And even we were only not much over asking price but the difference with this market and a buyer's market, which I'm confident that it's that, is that there's so many people that are underwater, had a variable rate. Property prices are down. So there's the environment is not the same, even though it's a buyer's market as it was 10 years ago in a buyer's market. So that's what I mean. At one point I'm like, oh, I've seen the real estate cycle. I've been around the circle.
Just when you think it changes, right?
Yeah, and I'm not sure exactly what other kind of curveballs could happen, but yeah, this is definitely an interesting one, and I'm sure you've seen a bunch of stuff. But let's start with maybe advice. Like you said, we got 60% of these 5-year terms coming up. Do you have advice for people on how to start to?
Yeah, 100%. So what we're saying to people now, we've kind of been saying for the, the majority of, the second half of this year is it's reasonable to assume that, if you're making your mortgage payments and everything's been fine, you're going to get a renewal from your current lender. Okay. And, if you're on a 5-year term, don't sign back on a 5-year term. Look at a shorter term. And the reason why we're saying that to clients, 2 to 3 years is probably more ideal. Let's see where the economy goes. Let's see where the rates are going. And really, the strong conjecture in the space right now is that nobody's got a crystal ball, but the thought process is that as the economy ideally gets better, we're going to see some modest decreases on price, maybe more on prime, I should say, more frequently, kind of starting mid next year. And then going into 2025, et cetera. So really, we should probably wait. Don't sign back on a 5-year term. Do a 2 or a 3 year, because I would hate for people to get into a 5-year term and get locked in on that, to be able to say, "Crap, after a year and a half to 2 years into that, now I'm stuck with this rate unless I want to pay a penalty to get out of it for another 3 years." So a little bit cautious. Don't sign back on a 5-year. And again, you probably won't have to requalify for that. Having said that, it doesn't mean you shouldn't have a conversation with your mortgage broker. Okay. There are many lenders out there who are competitively positioned to draw new clients in on switch transfers. Okay.
What's that mean?
It means that, your mortgage is coming up for renewal. It's matured, and your income ratios, your debt servicing ratios are fine. And a new lender will give you a really good deal to draw you into their book of business. Okay. Yeah. So what'll happen there is really it's no cost to you. Legals are picked up through FCT, a title service company. And if appraisal is required, they'll rebate up to $300, $350 depending upon the lender. So essentially, it's really no cost for you to switch over to a new lender. And lenders do that to draw potential clients and build their book of business. The flip side to that is that many lenders are also very aggressive on client retention. So what that means is that when you get your maturity renewal offer, have a conversation with a mortgage broker, and we give clients a straight goods. If that's a great deal and it's clear that the lender wants to keep their current client database, I tell them that.
Right.
And I would say, here's what you might want to do. If they're not quoting you anything but a 5-year term, reach out to their mortgage servicing department and ask them what the options are and the rate options for something less than a 5-year term. Right. Again, we talked earlier about the fact that the 5-year term is probably the most profitable for lenders. So you may need to ask the question about, can I get a 2 or 3 year term? And if so, what does that look like? And if there's no 2 or 3 year renewal option, you might want to consider moving to a new lender. Right. And again, we crunch numbers for clients all the time. So there's a big consultative process to this as people understand their next move strategically. And we're happy to help with that.
This all sounds good. And it makes me think of my job, where sometimes you have to do a lot of work, which results in not a deal or something that works out. And
what goes around comes around, Joe.
Yeah, but this is part of the jobs that we do, and I don't know if everybody even recognizes that or not. Like, we get compensated when we have
the deal closes.
A deal closes, and not when it doesn't. But there's a lot of things that we have to work on for people,
for sure,
that don't come to fruition for all different reasons. And when you're saying all that, I can just see that, where you're like, you're having them look into their current lender, maybe other ones, these different things, and then who knows which options they pick. They could even end up calling their bank direct or somebody else.
100%.
You've seen all kinds of stuff over the years, I'm sure too. But yeah, what I have confidence in with you being a problem solver and a good guy is that you're looking out for the people, which I hope that I don't have I still want to talk to more mortgage brokers, but that's not the type of one that I'd want to associate with, because those do exist out there that we're well aware of. But
well, Joe, I think the important thing is, I really believe in my heart that what goes around comes around. And if you are treating everyone, with transparency, and you're trying to be a good person and provide value, you may not land that deal on that particular day, but you're going to make an impression. And I know statistically that, one happy, satisfied client will create 3 new, strong business opportunities for you.
Wow.
So even just kind of stepping back and saying, okay, you know what? I'm doing a lot of heavy lifting for this person, and I've reworked this spreadsheet 9 times, because every time, I provide them with something else, there's a variation of, well, what if we do this? What if we do that? So, it comes with the territory, right?
Yeah.
And I think too, the good thing about that is that it does sharpen your game. It keeps you in tune to providing valuable information and making sure you're up to date with industry trends, lender products. They change their broker kit guidelines regularly. You got to make sure you kind of know what's going on, because you don't want to advise somebody poorly to find out that you gave them misinformation, and now you look like you don't know your stuff, right?
Yeah, totally. Mm-hmm. So what are some of the pain points or difficulties or solutions that you've been having with people renewing lately? Because people that have been renewing now from 5 years ago, there's already people going through some of this,
sure.
right?
Yeah, 100% for sure. So, one thing that we find to have been a really good option for some is that, let's say, for example, you've got, 2.5 or 3 years left on your mortgage, but you have a need right now to make a change. Okay. My thought process is, you know what, if it's not broke, don't fix it. Let's not break your current first mortgage. Can we look at the potential of finding something in second place that's going to be able to help you reach your goals, that is more economical and reasonable from a cash flow perspective? So we'll look at those options first. Now, there are some constraints. Many lenders that offer second mortgage products might not go in behind a first mortgage charge.
Yeah.
Or conversely, there might be a constraint in the current mortgage where there's no seconds allowed unless the lender gives express approval of that. Okay. So you want to understand what that looks like, and not just revert to, well, let's break your current mortgage and it's going to cost you $7,000 to be able to do that. And then that's the cost of doing business. And let's get you a new product in place. That might not be the best solution for the client. Right. So there's those conversations are happening pretty regularly. What's also happening is that people are really finding that they're having to move into the alternative space. Okay. Now, the good thing about that is that the alternative space has really grown in the last, February of last year, almost now 2 years ago. Wow, time flies.
Yeah, it does.
Is when the market really changed. The value started to decline big time.
Yeah.
And what was happening is that we had clients who, say, for example, were in on firm purchase sale agreements, closing April, May.
Yikes.
And what happened is that if the appraisal comes around and the market has taken a dip like it did, if you agreed to pay $850 for that property in February and you're under contract, and if the value of the property is not there anymore, what are you going to do? That was a reality for a lot of people.
That's so scary.
And what happened as well, Joe, is we were saying to people, well, when we run, because we have access to a system called Purview for mortgage brokers, and it's basically from Dainard, so it's from Land Registry in Ontario. And what it does is it draws through a bit of an estimate as far as your current property value is concerned. It's not going to replace, a professional for that, but it is a really good indicator. And it's based on comparables. Well, let's just say, for example, that when we were running those reports for clients and moving forward on assumptions for setting the deal up to see if the number is going to make sense.
Yeah.
What if the comparables, in that 3 to 6 month window brought you back into the time frame when prices were elevated? It's going to skew the current estimate. Okay.
Yeah.
So I was saying to clients, listen, when you move forward and you're looking at putting an offer on a property, please make sure that your realtor is using data after the drop in February. Because when we get to funding, that's going to be the reality.
Totally.
Right? So, and then people were like, oh, that's a really good point. Because what we were doing, again, not everyone, but some people were applying this. Well, this is how I always do a CMA.
Yeah.
Do you know what I mean?
Yeah.
When
comparative
really
market analysis.
Right. There's an anomaly there that would have to change your approach on that. Okay, so are you integrating that anomaly into the process to come up with a more reasonable value for the property given the current market conditions? Right. So I wasn't born yesterday, Joe. I'm not even a realtor, dude.
No, I know. And you know what's going on.
For sure. And I think that comes from, you know, I never want to be a realtor. I respect you guys for what you do. It's just not my space, but I appreciate the real estate market because it's so tied to what we do. So I think you can't be
work
ignorant.
together.
You can't ignorant. You can't be ignorant of that.
No.
You can't stand back and say, well, that's not going to affect me. It will totally affect you.
Yeah.
It affects your deal placement. It affects how you advise your clients moving forward. Again, from a financing perspective, not here to tell real estate agents how to do their job, but I'm here to be able to give insight to how their decision making and how they advise their clients are going to affect their ability to pay for the shiny, beautiful, you know, granite countertops, yada, 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 that you're trying to sell.
Totally.
Right.
Totally. And one thing I want to point out to you too, in a real estate transaction, for myself, the most difficult part is the financing part when running into, because in the beginning when I started, so many different banks or mortgage brokers were terrible.
Right.
I had so many bad experiences because like the real estate transaction from my perspective, from the buying side, is when somebody comes in and they want to buy a house, we want to get them pre-qualified. And sometimes, like even when I started, some people had been pre-qualified, and you have that different mix. But then you go out shopping, looking at houses, that's all on us figuring it out, looking online, whatever. And when you get an accepted offer, you're dealing with, along the way, a home inspector, whoever from the financing perspective, and you have a lawyer. And like home inspectors, pretty easy to find some good ones.
Sure.
And they're available. They're, capable.
Yep.
There's mixed opinions on home inspectors and liabilities and stuff, but I recommend them to people because I'm no home inspector.
Sure. Especially for a first-time home buyer. If you really want to know what are you getting yourself into, what's the remaining life cycle on the roof and all that stuff, right?
And have a second set of eyes. Like some people, like I explained to them, like just because a home inspector maybe missed something, like some people feel like, oh, now I can like sue them or whatever. But to me, like it's like an extension. It's having another set of eyes. Like home inspectors, they're not like professional HVAC people or roofers or whatever, but they have a general understanding of everything. But and like in the end, lawyers, like when they get the baton in a real estate deal, if you have a good lawyer, you know, that can work well. Even if you have a bad lawyer, if the deal goes fine, you're usually okay. But so many times when I started, I ran into nightmares with not being able to get a hold of the mortgage broker or bank. And it was,
it's frustrating, eh?
Yeah. And like to me, like that, I've had deals when I started, I can't remember for sure, fall apart, but I'm sure, or be on the brink of it because I'm like communicating with whoever's on the finance side when we get the accepted offer, right? Send over the accepted offer, the MLS listing, call them up. And sometimes it would take me a day or two to get a hold of them. Like, so then I started
and you're eating into your COF window. And,
we only got so many days. So like I learned quickly, like not to wait to break the ice with whoever's going to be dealing with the financing.
Get ahead of the curve.
Because like I can't have our first communication be when I'm sending over the paperwork. I need to know that I have their cell number, and some of these bank guys, they won't take calls after hours. Sure. It's not great, and then if that's the right email, how long does it, like I ask people, how long will it be before I hear from you? Because like when you have an offer accepted and conditional, and one of the pushbacks, and I get from your guys' side that it's not uncommon where if things run long, because it's not always on that side, it's sometimes the purchaser taking their sweet time getting some of whatever paperwork's needed, but looking for an extension. But like I never, ever, ever, even when I feel like I could get it, like I can get an extension. Because when we go to the table asking for an extension, we're losing some of our leverage with whatever else we've maybe negotiated, right? So yeah, I'm just pointing out that that's, for me, I always stress to people when I talk to them when we're buying, is make sure you have your pre-approval set with a good mortgage broker.
Well, let's talk about that a little bit. I think that, what we do, and we've always been a big proponent for this, is we collect everything up front. We treat the pre-approval as if you've got a live deal. except for obviously there's no purchase sale agreement. So there's going to be some assumptions made over, annual property tax, et cetera, et cetera. But we're getting, and in particular where a deal could go askew is on income. So we're making sure that we, like right from the first phone call, when I have a consultation with a client, I'm taking copious amounts of notes. And once the online application or manual application, whatever their comfort level is, because we have a secure online application portal as well.
Nice.
When that comes through, I always compare my initial consultation notes with their application. And it's not because I think they're being misrepresenting information, but there may be something they're just not forgetting to put down there. Okay. I mark down, do they get child care benefit? And if so, what are the ages of the children? I'm going through all of this. I'm sure somebody who, is reaching out is saying, oh my God, this dude's asking me a lot of questions, but it's all stuff in the context of deal structure.
Totally.
So that when that comes through and we're asking for 2 most recent pay stubs up front, I'm asking for the nature of their income. Are you guaranteed? Are you base? Is there variable income associated with that? It's a different treatment for all of that. We want to know that up front. If you just move forward and whoever's qualifying you and you say, hey, Joe, how much you make a year? And you say, $75,000, great to use as a placeholder for qualifying. But you find out that a big chunk of that is, $20,000 in overtime that you just started to get last year because your employer got a major contract. You can't use that. Now that really changes the deal. So you got to know that stuff up front.
Yeah,
totally. And then you got to make sure that when you move forward on that, you're giving them as solid of a number as you can because they're going to go shopping. Yeah. And that's when you're really going to start to create that emotional tie to a property. They're going to fall in love with something. I don't want to be the bad guy to say you can't afford it now because I didn't do my job up front when I should have.
Yeah, that's the worst.
Does that make sense?
Oh, it makes so much sense.
Yeah, for sure.
And I think it's great now how that you're, not now, but doing such a strong pre-approval. Because when I started, I feel like that wasn't super common, that a lot of people were out shopping a little willy-nilly and then kind of figuring it out later.
Sure.
And it's nice that that is more common in the industry because I think that's the proper way to do it. And I think that's great that you do it. And I feel confident too that if we were working on a deal together that you'd be doing your due diligence because I've had it before.
Right.
When people come to me and they tell me they're pre-approved. And then when we get an offer together,
it's not what it is.
It was some flooful.
Yeah.
Right?
And then when you go start having that live conversation with the lender and they get eyes on the income docs, and then all of a sudden it's like, well, we can't use this because A, B, C, D, or E. And now you're like, oh my God, they're under contract now, for a property that they can't afford,
Yeah.
That's stressful not only for you, it's stressful for the client, it's stressful for everyone involved in the process, right? So get it straight up front. Yeah. Get it as close to being perfect so there's no surprises.
Yeah.
And that's one thing we do as well. We want to push back on the lender during the COF to be able to verify income as the first thing we pressure them on.
COF.
Your condition for fulfillment.
Oh, yeah.
So we're in that window.
Yeah.
Do you know what I mean? Is that what you guys call it? I don't know why I call it that.
I just call it conditional period.
There you go. Yeah. So when we're in that time frame, we want to make sure that the first thing they got eyes on is income. Yeah.
What is, I don't know if you know it off the top of your head or not, current rates? What are some of the rates we're looking at right now?
Yeah, so in the prime lending space, it's interesting. Lenders are going through volume decreases as well.
Totally.
So what's happening is we're getting phone calls from our business development managers, phone calls where it used to be emails. And what's happening is management is saying, phone your top brokers. Had 3 phone calls today. Hey, Steve, it's Joe from ABC Lender. Just want to let you know we've got, a quiet special, a whisper special, right?
We got to get this money out.
Exactly. Yeah. We've got investors in this book of business. We want to get the money out in the streets, and the rates are really decent. So let's just have a conversation about mortgage products, okay?
Yeah.
So you have insured mortgages. That's default insurance. Those are mortgages legislatively that have less than 20% down. Okay.
Down payment.
You must have, a default mortgage insurance policy on your mortgage contract. Okay.
Is that in Ontario or Canada?
I don't know, Joe. I'm
Ontario
saying
for
Ontario
sure.
because we're licensed in Ontario.
Yeah,
Okay.
perfect.
I would think it's Canada wide.
Me too.
It's Canada wide.
Yeah.
So what would happen is that for an insured deal, okay, and that also is a home that is less than a purchase price of $1 million, and it's also an owner occupied property with rental units up to 4 units. That all falls under the insured umbrella, or the insurable umbrella as well. And so what will happen is that those rates right now on a 5-year term are kind of coming in at 359, 539, 534. Okay, 539, 534.
5354.
Yeah.
Gotcha.
In that window. Okay. And that's the same for an insurable deal, which should say, for example, be a switch transfer. Okay. Or a conventional deal that's less than $1 million, but you have to have at least 35% down, skin in the game. So that 65% loan to value or less seems to be priced in the same area as an insured deal. Okay. So conventional deal, just 35% down or more, you'll access that 5.34 as well. Okay. So then as far as conventional deals are concerned or uninsurable deals, refinances, et cetera, you're seeing them kind of come in, high fives. So 5, 7, 9, we get some specials for. So we have status with all the major lenders. And so what happens with that is we get access to discretionary rates with a major chartered bank. So their posted rate, we'll say on a product will be, 619. Okay. We'll probably be able to get it cheaper than that for sure. So there's a process associated with that. Okay. So it does help when you're dealing with somebody who's been in the space for a while and has these lender relationships.
Totally.
Okay. And again, those are on 5 years. Anything that is a 30-year amortization, okay, is uninsurable, and there will be a premium associated with that. Okay, you won't get that low rate. It'll be a little bit higher, probably 10, 15 basis points depending on the lender higher. Okay.
So, and the reason somebody does that is to make the payments lower so that they can afford it.
They could,
right?
For sure. Yeah. Normally, it's mostly about cash flow.
Yeah.
Okay.
So that would allow them to afford it now. In the long run, it would cost them more because of
they pay more interest to the lender across time, but also too, let's put this in perspective. Okay. You're really talking about a 5-year, in that example, relationship. So it's not as if your whole mortgage, amortization life cycle is going to be at that higher rate. Your dynamics are going to change, but from a comparative perspective today, you're absolutely right. Okay. The takeaway there is that on a 5-year term, 30-year amortization, you will pay slightly more interest to the lender across, and then if you were doing a 25 or a shorter year amortization.
Gotcha. Right? I want to pivot a little bit because you telling me this, I'm trying to think about what's going on with these lenders, because if they're feeling the pinch from sales being down and they've got some money that is rolling or not rolling that needs to get put out, how do they pivot with time if sales don't pick up? What do they do with that money?
Well, what's interesting is that there's also a lot of discussions with lenders where, let's say, for example, so in our space, there's the charter banks, lenders, okay? There are the monoline lenders, which are like the MCAP, First National, et cetera, that really only deal in mortgage financing only. Okay, they're not selling you. They're not selling you generally for credit cards and RSPs and all that
just
stuff,
mortgages.
Right? Mortgages only is their primary business. That's what their book of business is based on, their profits, et cetera. That's a one product, monoline lender. Okay,
interesting.
So what happens is that typically in the monoline space, on a conventional deal. So not like a high ratio deal, because there's more constraints around that because the insurer has set those maximum affordability guidelines. Okay. Not as much flexibility on that. In the conventional space where, an insurer is not involved directly, what's happening is that they're bulk insuring. So lenders are bundling X number of mortgage contracts together and going to the insurer to purchase a default insurance policy to protect their book of business. But that cost is not passed on to the borrower like a high ratio mortgage is.
Interesting.
Okay. So what happens is that there's more flexibility in the conventional space. So we just had, I have a team and I'm a part of 4 team leads that got 50 agents. And so we have lenders come through to us regularly. Every Wednesday, we have, something called open mic where we talk to the team about anything they want to talk about: marketing, lenders, products, etc.
Right.
So we had a lender come through. And so the conversation was, what are you seeing in the space right now that maybe you are approving that you weren't approving 2 years ago?
Okay.
So what's happening is that there's more flexibility on management granting an exception based on the issue. Where that used to be in the space was your maximum affordability ratios. Monoline lenders were not in the A space, the prime lending space, were not prepared to have conversations about exceptions on TDS and GDS.
They were more picky.
Now they're having those where typically we only saw that happen with our chartered bank lenders because they're a balance sheet lender. That means that they're not going out and getting that bulk insurance policy on their book of business because they make so much money, they can absorb potential mortgage losses through their balance sheet. Okay. So they had that flexibility right from day one on the conventional side. Okay.
Yeah.
So we're seeing more of those. Is it reasonable conversations with monoline lenders in the conventional product space where a couple of years ago that just wouldn't happen, So that was a really good conversation. And that is all about adopting to the environment.
Right. So
here's our new reality. We need business. What are we prepared to have a reasonable conversation about? And does that make sense? Again, one-off basis, but if you think you have, a deal that makes sense and you can mitigate some of that potential conversation, that's our job to present that to the lender so we get your deal approved.
So let me try to digest that a little bit, because what I'm hearing is right now, from my perspective, we're looking at a buyer's market where what that means to me is there's a lot of inventory, so a lot of options for buyers. Houses are sitting a while, which is giving buyers the opportunity to negotiate, get prices lower than what sellers are asking, be able to protect themselves with conditions like we weren't seeing much of for a while. So this is, we're talking about, from my perspective, in the purchasing process, a buyer's market and how that works for them. And what I'm hearing from you is the same type of things where in this buyer's market, the buyers also have more leniency when going to lenders, where they have more opportunities to try and figure out solutions. Because is this what I'm hearing?
For sure. 100% for sure. And again, I just want to stress that that's on a case-by-case level.
Totally.
So say, for example, Joe, in your situation, you had a really big red mark that was going to be a bit of a deal stopper, and having that type of a conversation with a lender, that thing probably wouldn't get approved.
Yeah.
But let's say, for example, your total debt servicing ratio, so that's all of your debt, including the new mortgage and car loans and credit cards, et cetera. Let's say, for example, that was, higher than the ideal, the maximum as documented by the lender. But let's say, for example, it wasn't, 10, percent higher, but it was, within reason, but you had some investments, but you didn't want to break those investments because they were locked in, or you're earning really good money on that investment. It makes sense from a lender perspective that if you have, access to liquid resources, that you could have somebody to fall back on. That type of thing makes sense from a lending perspective. So again, it's on a case by case basis.
Totally.
But there is more flexibility now, and those conversations just never existed, 2 years ago.
Yeah, which is interesting. So the buyers have more opportunities, because it's, from my perspective, there's a lot of people that are nervous in the buying process. Like when the market was on fire, they're like, prices are crazy. I'm going to wait for prices to come down.
And they never did.
Well, when they did,
right.
When they did, because we've seen prices come down, but then what happened? Interest went up. And they're like, now interest is too high. I'm waiting for interest to go down.
Right.
And then when that happens, prices will go up. And it's just like some people looking for, like, they want the best of all worlds to happen, right? Prices to go back to 5 years ago with the same interest rate, and be able to buy the same house. But
It's not going to happen.
It's not going to
That market's
happen.
gone. That opportunity is not there anymore.
Yeah. And now there's opportunities we're seeing now because like we think it's a good time for people to buy if they're able to, because like at some point, interest, like we just seen Bank of Canada, like last week announced it's unchanged. And like, I'm telling people my perspective, I could be wrong, that even if it stays stable for a while, as people get comfortable with the market, I know these chairs suck. Eh?
No, it's good. No.
As the market stabilizes and people get used to the environment, I think that people will be buying some more again, and that will help bring inventory down, and maybe we'll see prices go up, especially when interest goes down. But there's been so much uncertainty, like I've been seeing on the front line of real estate. Like this year, Kev, that prices houses for us, he's priced more houses this year than he ever has.
People are just looking at options. They want to make the move, but they're not sure if they can make it work on paper.
Yeah, and like they get the house priced, and then they look at it, and then they don't do it for whatever the reasons. Like it's clearly not worth as much as they thought, because reality is harder to swallow that way.
But the flip side of that, Joe, is they're buying at a lower price as well.
Right.
Like it's kind of relative, isn't it?
Totally.
To a degree,
It
right?
totally is.
Yeah.
But that's part of like the education and the market stabilizing and people like learning, because me and you, like we eat, sleep, and breathe our businesses. So like we understand what's going on as much as we do. And not that we know everything. Yeah. But then
we're on the pulse.
We're on the pulse. But then that's not the market. We're not the market. We're not the ones buying and selling all this stuff. Yeah, we're coaching people and all that stuff. But that's why I think that there's, like, I remember hearing it and I couldn't believe how true it was until after, like during COVID, there was this pent up demand. And I couldn't believe, like, because like we were like shut down for like a couple weeks or whatever. And then like, when things were,
it was nuts.
It was nuts. And it was like, how the gates being closed for a couple weeks make it seem like years of stuff.
And that's when everyone was moving outside of GTA. They were buying properties in other provinces. The northern, we're getting out of Dodge. It was crazy, you know?
Yeah. And
so sorry, sorry to interject here.
Yeah.
But back to your earlier point about people trying to get their head around, is now the right time, I know that the rental market in Niagara is pretty strong. Prices are kind of high. I hear a lot of people, renters in particular, talking about how much you're paying for rent. And so a part of me says, to your point, if you're in a position to pull the trigger and you could consider buying, what might that look like for you? So I say, go through the process.
Totally.
See what it looks like on paper.
Totally.
You don't have to make a decision then. This is all part of that fact-finding process and getting your head around, is this even plausible? And again, too, I know that rates are important. Don't get me wrong. I totally understand that. But rate is not everything.
Right.
And especially in a market like now, I really kind of want to revert, and use a lot of language around cash flow. What does it really look like to the bottom line for you? You're used to paying X number of dollars right now, plus utilities, et cetera, et cetera. What might that look like? Because prices have come down, but yes, the mortgage rate will be higher. What does it really look like for you? Is that something that you may say, wow, that looks like, an opportunity we could dive into? Because there's so much, justifiably so, negative rhetoric around the sky is falling, recession, interest rates are at the all-time high. The challenge, Joe, is that we were at such a long trough of unrealistically low mortgage rates that people are saying, well, we need to get back to norm. We need to get back to 1.19%. Are you on crack cocaine? That was never anyone's norm at any stage of the game.
No.
We were just at a really long low. All markets are cyclical. When the rates started to kind of come back up, the conversation changed very quickly too. Well, if we look at our 25-year, average mortgage rate, 5% is really more of the norm.
Right.
But people were conditioned to 2% being the norm.
Yeah, totally.
And it was just like, no, that's take advantage of it while you can, because it may not come back again in our lifetime.
That was free money, basically.
100% for sure. 100% for sure. So I think cash flow really is, a conversation that people need to look at. And again, interest rates, 100% for sure. I get it. It's important. Okay. But, you need to kind of weigh that against what do you want for your family? Do you want to, get into a new home? Do you want to buy your first home? What does all that look like? You talked about, the average, appreciation value in properties across time, and there was a time frame, we deal in reverse mortgages as well. So we do a comparison for our clients on what does the appreciation look like across time for your current home, and then offset that to what is the mortgage interest rate that's accumulated within your property as well. Because people see that product as being, really more highly priced, and it is, okay? But again, they're focused on the interest rate. Well, what does that really mean to the bottom line here, right?
Right.
So we'll do the comparison on both to show them their net equity position across time. So I think that property appreciation is a really big conversation I don't see a lot of people having in the non-reverse mortgage space.
So when
as regularly, right?
Reverse mortgages, that is, from my understanding, people that are around their retirement so that they can dip into their equity to be able to pay. Am I right or wrong?
100% for sure. So what's interesting about this, it's not for everyone. Okay. And historically, reverse mortgages got a really bad rap because
why I was even surprised you mentioned it.
Because of the US market.
Okay.
Back during, the bubble, 2007, 2008, what happened was kind of like the Wild West. There was not as much regulations or structure around people accessing reverse mortgages in the US. And what happened is that a lot of people lost their homes. Like the lender would come back and say, listen, you're in a negative equity position. The sky has fallen. When you got your reverse mortgage, your property was worth X number of dollars, and now it's less than 20% of the original value. Sell your property because we want our money back. In Canada's mortgage system is very closely it's very similar to the Australian market. Okay. There's a lot of government legislation and regulation around accessing mortgages, et cetera, okay? So the product in Canada is not the same as the negative rhetoric that happened in the US. Because of the market so much larger,
different.
People are kind of thinking, oh, it's the same, right? It's not the same.
No, they have 25-year mortgages there.
Right.
Where you lock in at your interest.
I think you can actually get longer, but yeah.
The interest rate, which I just learned about not long ago. But
100%. There's no term.
It's wild.
It's amortization only, for sure. So I think, the reality is that Niagara is an aging demographic. Like statistically, we have a larger percentage of people that are in they're senior elders. Okay.
Yeah.
And then so reverse mortgage is really, you have to be 55 years of age or older. It's always a dynamic of 4 factors: age, sex, property type, and property location. Women get less money than men because they live longer.
Oh, okay. Wow.
So what'll happen is
because they're better than us.
Well, there you go. Do we actually have to state that? Because we know it's true, right?
Facts.
So I think that the really good opportunity here is that pensions, investments might not be lasting the way we thought because people are living longer as well. I heard something the other day, this week actually, which kind of blew my mind. And I think there's been some conversation out there that the person who will, the first human to live to 150 is walking on the planet today.
It's wild.
And it's just
I don't think it's one of us.
I don't think it's one of us either, but that's another conversation, right? It has something to do with the life we lived when we were in our teens and our early 20s, right? But that's another podcast, right?
No doubt.
So what's happening is that, people's reality about financial is just not there anymore, right? But they have all this equity in these great properties. So this is a really good solution for people who want to stay in their current community, who love their house, love the fact that they're shopping in their church and their social community is all has been here for decades. They don't want to move. Okay. So you can actually, access some of that equity. And one of the options is no payment. So what happens is that the maximum amount of money you can get based on your current property value is low. 35, 40, 45% max based on those 4 factors, age, sex, property, location. There's an algorithm they use to determine, what your property, how much money you can access. And then so the reason for that is that as that interest accumulates within the asset, you're always going to be in a net equity position.
Right.
Okay. Let's say, for example, but it's just like any other mortgage. It's registered on title on the property. The bank doesn't own your property. You do. It's just there's a mortgage charge that happens to be a reverse mortgage on your property. And then you can also opt to either take a lump sum payment,
Really?
or which you could use to purchase an investment property with your real estate guy Joe, and have an income stream from the rental property. Now, a reverse mortgage cannot go on a rental property. It must be an owner-occupied property.
Primary residence.
Yeah. But you can use the proceeds to travel the world, buy a condo in Florida, go cruising every 6 months, whatever you want to do.
So let me ask you this. What's the difference between that product of a reverse mortgage and a secured line of credit?
So a secured line of credit potentially is you're probably going to max out at some point. You're being set up for, and the other reality is that your minimum payment option on a HELOC, a home equity line of credit, secured against your property, is interest only. Now, there is one product out there from a pretty big lender where what they'll do is they'll set up your maximum line of credit on the property. And as long as you are staying south of your max, the interest will accumulate within that particular product. But that's only one lender. Okay.
Right, yeah.
With other lenders that have HELOCs, what happens is the minimum monthly payment is interest only on current balance. Okay. So a little bit of a different structure. Okay.
Yeah.
I think the product that I think you're thinking about is the same one I'm thinking about. So that could be reverse mortgage like.
Yeah. Similar idea.
Okay.
Similar idea.
But on this particular reverse mortgage, you also can make a payment. Okay. You could make an interest only payment and keep the balance on the mortgage at what your initial advance was. If legacy and equity and leaving your family is an issue for you, you might want to consider that. Okay. Many people, because we're living longer, are of the opinion of, well, you know what, the kids are set up, they're professionals, they've got their own, portfolios going on. We want to have a quality of life, You also may find people need to access money to be able to have in-home services to help for the day-to-day. So there's lots of variations on this and lots of reasons why people might consider this type of a product. But I think it's great. Now, not everyone qualifies for it. You still need to be responsible as far as your credit is concerned. You still need to be able to have a cash flow, either through CPP, OLAID security, or whatever, to be able to pay for the annual property taxes, $100 a month for heat. So that's still there. Okay. You still need to quote unquote qualify, but it's not the same. You're not qualifying for a mortgage payment.
Now, I want to bring up something. I went for lunch with somebody the other day, and we were talking a little bit before our time, probably even your time. But at one point back in the past, people were able to buy a house, and sometimes I haven't heard of it like more common in modern times, but buy a house and pay it off in a reasonable amount of time, like 5, like 10 years, just by like going at it, and not having like I've heard like, because I come from an immigrant family where there's been like some families that have been able to pull that off, where I haven't heard of anybody in recent times paying off a mortgage really quickly.
So it's interesting. So all lenders have some form of a prepayment privilege.
Yes.
Okay. So this is a couple of years ago, maybe 3 or 4 years ago, I was at an industry, conference, and somebody from one of the major charter banks was there. We were having a conversation, and so with this particular lender, you could increase your regularly scheduled contracted payment by up to 15%. You could make a double payment every payment date.
Wow.
You could do a lump sum payment of up to 15% annually of the original borrowed amount.
Wow.
Okay. So all of these options are there. And this is a major lender. Okay. And do you know how many people actually in that time frame took advantage of that? 18. Like it was and this is a lender that deals with thousands of mortgage contracts.
Yeah. Yeah.
So I think the reality is that what we find many people are gravitating towards is they like the flexibility of increasing their mortgage payment by up to X number of dollars. Okay. Because from a cash flow perspective, that makes sense to them. Get paid every 2 weeks. Here's what we have as far as, net income is concerned. What does that payment look like? Let's round it up. Instead of, paying $1,248 every 2 weeks, let's pay $1,500 every 2 weeks. As long as that's within, the lender
budget.
guidelines, then you can do that. Right. Yeah. And then, so that will make a really positive impact on your amortization. Okay. You'll start to see, the amortization come down pretty quickly,
Right.
Also, opting for an accelerated, biweekly payment really helps you right out of the gate. And that's not with even changing your payment.
Right.
Okay. So there are ways that people can realistically look to bring down, the balance with just some really straightforward tactics. If you are in the position of, between you and your partner, getting a really reasonable income tax return, and you're just blowing it, put it down as part of your annual prepayment privilege, and just kind of use that as part of your moving forward strategy if you're in a position to do that.
It seems like the mentality of people now is different than it was back then. It seems like it was more common at one point to try and pay off that mortgage as quickly as possible, where
100%.
Now, I guess, is it maybe people are just more focused on like living life now versus
right.
That's got to be it, right? People just,
and I mean, it seems kind of overwhelming. I'd like to think that maybe some things are relative, but I'm not so sure that paying off a $26,000 mortgage back in like 1973 is the same as paying off $1 million mortgage in 2023. I just, that's a really big leap.
I know. I've never dug into those numbers because, like you said, at one point, houses were that price, but it also, I've never really done that math to see people were making like $1 an hour then.
Right.
So I don't know, like it's hard to calculate those things. I know that there's some stuff out there and I've tried to do it before, but then you have like all these factors and it's like, where do you start drawing the lines with like the cost of living and what it was then? And I
think the bottom line here is that everyone needs housing.
Yes.
And so if you're in a position to be able to, support and have a good quality lifestyle, whatever that payment's going to be for home ownership, why wouldn't you do it?
Yeah.
Start to chip away at that, build some equity within, your primary residence and just kind of see where that chips. There's so many variables that happen across time and in life. It's not linear, You may have a year where you made some really good headway on the mortgage, but maybe something happens and all of a sudden that changes for you,
That happens.
For sure.
Yeah. Yeah. It's interesting. I want to try and offer more advice to people that are listening. And like one of the things that I see might be happening at some point is how it used to be or how some demographics do it where like people getting together to buy a house.
Right. Shared ownership.
Sure. Like I've tried to encourage it because when I talk to people, like being a problem solver too, it almost like hurts me when people say, how will my kid ever be able to buy a house? I'm like, well, I know it's hard, but it's still possible. And like one of those things is like, do you get a group of friends or people together? And because that's how people have done it. That's how some families do it. They get multiple families together. Now, I'm not going to tell you it's the easiest thing to do, but as we know, there's almost always a solution somewhere for something.
Well, so I think you raise a really good point. I think one of the primary considerations here would be, if you had two couples who wanted to get into the market and they found a duplex that they could both, live in, awesome. Have somebody a contract in place, 50-50 ownership, across the board. What's going to happen if, party A wants to move out, but party B wants to stay? What does all that look like? Okay. It may not result in having to sell the house and split the proceeds, above the mortgage balance 50-50. Maybe, I buy you up based on current market value. But the other thing too is I didn't need to qualify for that. What if I can't do that? There's a lot of considerations, right? If you have a couple of couples going together and I'm owning a portion of your property, but I'm not living there, well, technically, is that a rental property? It's not your principal residence. And is there a capital gains consideration when that property is disposed of? There's a lot of considerations on that. But I think though, if you had a couple of people who were interested in the conversation, it's part of the fact-finding process. You want to, what we see more regularly is the bank of mom and dad helping
Yeah,
out as far
totally.
as qualifications are concerned. You know, and similarly, we deal with a great real estate lawyer. I mean, she's absolutely fantastic. We love her, and so one thing that she's kind of put to the forefront. And again, I just want a disclaimer here: I am not a real estate lawyer. I'm going to talk to you about what I think is my interpretation of what's happening.
Yes.
Okay, but you know, listeners need to do their own due diligence and talk with a legal professional.
I like the disclaimer. Yeah, disclaimer for sure.
So, you know, what we'll see in that situation is, you know, on the capital gains front is what's known as a bare trust agreement, where really the bare trust agreement is signed and it says the intention of mom and dad coming on to the property was for mortgage financing purposes only. So that when the house is sold in outlying years and now the couple moves up their property ladder, okay, there is a defensible document in place, you know, that was signed on day one that says we're only in this so they could get into the house. The qualification standards, we're qualifying at a much higher rate than what the reality payment was going to be. We're only helping them so they could buy their first, you know, family home. Okay. So, and my understanding is that that's quite successful in alleviating the potential tax conversation around capital gains on a non-owner occupied property. Okay.
Right.
And that's where we talked earlier about, you know, your referral network and the people who are there to advise you are really critical, because mom and dad may move forward thinking innocently enough, well, we're just co-signing.
Yeah.
There's no just there. There are considerations for that.
Totally.
You know what I mean?
Totally.
Yeah, yeah.
And you're absolutely right. When going through this process, it's so key for people to find the right professionals to help them through, because it can be
as the ball is moving and it's changing, and
and
for
it's so important, because these things could be the difference between somebody getting a place or not,
and getting sued.
Getting sued, all these things. Yeah, because there's pitfalls out there. And yeah, when you have people that know their stuff and experience, it definitely helps a ton.
Well, a big thing we're seeing now is, you know, people getting in on pre-construction contracts at, you know, prices that are not the reality today. And I don't even
Are you in that space?
No, but we have had a couple of clients who've come forward, and you know, and I just hope is there, what's the way out? And so through our real estate lawyer, we have occasionally have conversations with these scenarios, because I want to know what's going on. You know, I want to know what's going on from your perspective and from a realtor, and what is she seeing on the real estate law perspective? What's going to help me advise or steer our clients in the right direction to find more information?
Yeah, because like you mentioned about that with people buying houses, resale, used houses, I like to call them sometimes, but is when the price went down over a couple months. But yeah, like I was kind of just mentioning to you a little bit, Vlad, that I have working with me, but he's in Ottawa. Like with him, he's on the front line of pre-construction because he owns a software company that supports that type of stuff. And it's really interesting to hear all the things that he's seeing and like being around that space, because there's a lot of people that bought pre-constructions and the values are way
and they have a lot of money tied up in that process for
big deposits.
Exactly.
Yeah, he just has one today, $100,000 deposit, and somebody's looking to get out of the deal and they're willing to walk away from their deposit.
Oh my God.
I don't know if like even with that 100,000 into it, I don't even know if the deal can still work. Like, and there's a lot of people not being able to close on a lot of those deals. And I don't even know. I'm not on the front line of that, but that's like causing a disruption.
Well, I'm wondering, you know, if there's an opportunity, if somebody had a ton of money, you know, and if somebody was willing to walk away from, and they could assign the contract, and if you just gave me that $100,000, and now all I got to worry about financing is the balance. Yeah, technically, I'm getting that property for $100,000 lower.
Exactly.
Does that make sense? You know, but you know, trying to find, you know, that client base could be challenging, right?
Totally. Yeah, and there's definitely opportunities, like we said. It's when a buyer's market's there's opportunities for the people that can have the finances or the resources to pull it together, because
it's scary. So what, Joe, I mean, I don't know, what are people actually doing? Are they having to walk away from those contracts and just let the chips fall where they may, or what?
That is happening.
So I actually have a client right now who's working on a pre-construction, and they were able to go back to the lender and negotiate a $100,000 price reduction on the property. Now, I think that's a rarity.
Yeah.
But I think that they were lucky enough to be able to do that, and maybe, you know, the builder was motivated.
Yeah,
and said, I need to move on this.
There's definitely, just like you said, there's opportunities to try and go to the table, and different people have different things that they can do. But yeah, there's some wild things going on with that, and it's interesting to see how it can develop.
Well, we're dealing with clients right now too that have purchased pre-construction, and they're scheduled to get it in May, and it's like a $2.6 million house. Okay.
Wow.
Now, they originally were selling their house, and it's been on the market, and they can't move it, and it is beautiful. It's gorgeous.
But it's not.
So now I got to find a way to. Well, I think it's competitively priced. It's just that the market at that price band is not moving like it would 2.5 years ago.
Oh yeah, right? every price point. But yeah.
So now it's like, so we're trying to find a solution for them. And so I have a lender. I think what we're going to do is we're probably going to be able to do a bit of a blanket, because they've got a ton of equity in their current home they're selling.
Yeah.
So I'm working on trying to be able to create a package that's 6 months max type thing, so that they can blanket that, get the money for the new purchase, move forward, and give some more time to sell their current home. But those deals are because she's got like $230,000 tied up already in the new purchase.
Yeah.
How can you walk away from that? I mean, it's just mind-boggling. So I got to try and find her a solution. I think I have it.
I hope
but
so.
She also realizes that it's a complicated situation. So that's good. At least she's aware of the fact that what I'm asking for is a big ask. Anyhow,
that's what I mean.
Stressful.
And totally stressful. And that's what I mean about this being a buyer's market, is the completely different environment with all these things than when I started 10 years ago. Right. Because 10 years ago when it was a buyer's market, it was flat and people were used to that. And that was the environment. Mm-hmm. It'll be interesting. Like these waves have been wavy, and going through this, and where the next couple of years are going to be pretty interesting to see.
Well, it's interesting. We talked about that whole 60% of 5-year terms kind of coming up. And so when I looked at that, I was like, okay, well, does that mean that lenders are going to be super aggressive on client retention? Are they, if they got money and it's been a little bit flat for them, and now they've got all these contracts maturing,
and they want them all,
and they want to keep them, how aggressive are they going to be on trying to retain those clients? Yeah. Okay. Yeah. What is that going to mean as far as the renewal rates they're offering that segment of their book of business, right?
What do you think?
I think it's going to depend upon the lender. And I think what's going to happen is that my guts tell me there's going to be some aggression, but I know what's going to happen is that these lenders are going to be inundated and overwhelmed with dealing with these volumes. So I see this as being an opportunity for the mortgage broker channel because we're more responsive, ideally.
Right.
We're getting back to people in a much more timely manner, Totally. And I think because people are stressed out over the situation like we've just previously discussed, I think it's going to be an opportunity for, mortgage originators to start to bring back some of their book of business that's been a little bit flat in the last, 12, to 16 months.
Yeah. Have you seen more people going to banks versus going to you guys, or just flat because the sales have been down?
So generally flatter because sales are down, but renewal space is there. Like that's what we're doing. We're getting some purchases, but not like we were before. Yeah. Okay. Yeah. So the mix of our business now is more in the renewal space, second mortgages, private mortgages. People are looking for a solution that's more short term to be able to keep the Band-Aid on.
Yeah, navigate the water.
But there's a whole other set of risk associated with that, which we won't get into. We can talk about private lending at another podcast, which is a super interesting conversation. Yeah, but more than that, I think that people need to be aware of the fact that Canadians love their chartered banks. Mm-hmm. Like historically, especially the bank of mom and dad, everyone went to a chartered bank. Do you know what I mean? Mm-hmm. So I think the challenge becomes, newer generations are more open to being more client-centric. They want to be involved in the process. They're programmed differently. Information is available to them.
Right.
That means you need to be more inclusive, and they're open to alternative conversations, not alternative lenders, but not chartered bank scenarios. They just want the best product at the most competitive price they can get, but they also want to understand what they're getting into to a larger degree generally, and they're understanding it because they're doing a ton of research. Okay.
Interesting.
So I think that the opportunity there is that, and the number's pretty decent. I think, the last time I checked the CMHC annual mortgage broker survey, about, 27% of all mortgage originations happen in the mortgage broker channel.
Oh, yeah.
And about 60% in change happen through chartered banks.
And then the remainder?
Is credit unions, alternative lenders, things like that. Do you know what I mean? So there's a big chunk of the mortgage industry in Canada that relies on the mortgage broker channel. Now, what's interesting is that we have access to all kinds of lenders. We can sell to chartered banks. We can sell all local credit unions. We can sell a third charter bank is coming on board, very soon. Okay. Wow. So we have like a whole host of other lenders that are in the competitive space.
When you say we, you mean
the mortgage broker channel.
Yes.
Okay. Yeah. And so really our job is not to align you with one particular lender. It's just to find the best product for you based on your situation. Now, having said that, maybe a large percentage of those borrowers fall into similar buckets.
Right.
Okay.
Totally.
But there are a lot that don't. So I think the stigma around a mortgage broker being there's a lot of work's been done on us being one step up from a used car salesman. Okay. There's a lot.
One step up from a realtor.
Listen, maybe two.
Yeah, no doubt.
But you get it. There's a lot of negative rhetoric that's historical in basis, but the industry's come a long way.
I feel like, I don't know if it's because I'm too deep into the forest, but I know when I started, mortgage brokers had a bad rep and people thought it was only for people that
they're still out there.
Yeah, that like B lender or whatever. And like I've always been like a mortgage broker shops just like all these options. Right. So I find in my experience, almost always, not always, I can't give you guys the always, but almost always it feels like a mortgage broker can get a better deal than going directly to a bank. Almost.
For sure.
And I know that's not always the case.
No, for sure.
But yeah, I feel like I remember I had more of a challenge at first trying to encourage people to talk to a mortgage broker versus bank, because I still tell people that it's a good idea to talk to your bank because I think it's good to shop.
Sure. Well, we can sell banks.
Yeah, totally.
That's part of our arsenal.
Yeah, totally.
So I think that's probably also maybe, and I think the bottom line here is that I don't think that the mortgage industry has done a great job at positioning our value proposition from a public perspective. We just don't, I think the lenders don't have the bottomless revenue buckets like some major Canadian banks.
So let me insert one thing. Yeah, I want to insert one thing here before I forget too. I think that it's important for people to know too that when they work with a mortgage broker, they don't have to pay the mortgage broker. You guys are getting paid from the lender. Right. So
and then so that's a really valid statement on the A's and Adam's side. There's basically three buckets of lending. A is in Adam, B is in Bob, C is in Charlie. A is in Adam is all your charter banks, your monoline lenders, a competitive, lenders, et cetera, et cetera. The B is in Bob is your alternative lending space. The rates, aren't that much higher, but there's more flexibility, for example, in products. So for example, if you were business for self-employed, there is an approach where you could do a bank statement approach. You have the revenue stream coming in, but maybe you're not claiming everything with CRA. Oh, sorry, let me clarify that. You're writing off everything you can to reduce the income tax impact. Okay. Yeah. Well, in the A space, lenders are looking for your bottom line on your notice of assessment to qualify you for mortgages. In the alternative lending space, they're not looking for your notice of assessments. They're looking at a reasonable approach for cash flow. How much money do you bring into your business accounts? And what are some of your standardized monthly expenses that we're going to take off of that? So they're able to utilize a higher income number to qualify for mortgage money. Those people may choose to stay in the alternative lending space forever. because maybe their accountant is writing off everything under the sun and they're just never going to qualify in the A space.
Yep.
And they're okay with that.
High expenses.
That's the reality. Do you know what I mean?
Yeah. It's a balance.
For sure. And then the C as in Charlie space is your typical private lending space. Either private mortgage investors, people with money like you who are loaded, or, mortgage investment companies, et cetera. And again, as you get further away from A, prices go up, et cetera. So your comment about getting paid in the A space, 100% for sure.
Yeah.
In the B as in Bob space, the alternative space, we do get commission as well. But typically those terms are lower. You're not ideally going to put your client with a 5-year term in the alternative space. It's more 2, 1, 3, depending on whatever. Okay.
Yeah.
I've heard some brokers charge a broker fee on top of the commission in the alternative space because it's just as much work for those transactions that they're doing where they're getting 100% commission, or a commission, I should say, from a mainstream lender.
Yeah.
We don't do that. Okay. Because what goes around comes around. We're going to get you ideally as a client, in a year, 2 years, 3 years down the road, and you're going to love what we do. And you're going to tell your friends and family, we're going to get 3 clients from you.
Yeah.
Okay.
Totally.
And then in the
long term,
and in the private lending space, nobody pays the broker. So there will always be a broker fee associated with that transaction.
Yeah.
Okay.
Yeah.
What that broker fee is depends upon the broker. And I would caution borrowers to shop around for what those fees look like, because they can vary a lot depending upon the property type, where you're located. Some brokers in major lending centers may charge significantly higher broker fee. We try to be reasonable. We recognize that, hey, again, people aren't made of money, and we try to be reasonable on that. But we also recognize the fact that's a lot of work. And it's interesting too, just to substantiate the fact that a borrower would have to pay a lender fee and also a broker fee. Is that it's a lot of work in the private space.
Oh yeah,
we're representing the private investor,
the
and
lender,
also the client.
Yeah.
And so there's a whole set of documentation for each party. It's basically more than double the work. But having said that, we try to be reasonable.
It's multiple representational. We run into that same type of idea within real estate when we represent buyer and seller.
And seller,
Yeah. What did I take a note over here on? Oh, no crystal ball here on this one, but we were talking about interest and everything and it being historically low and how right now it feels like it's high. Do you think we'll see it at any time in our lifetime? Hopefully we both don't live to it. Well, I don't think I'm going to live to 150, but do you think we'll see it be higher than it is now at some point? That's a crazy crystal ball question.
It's interesting. So I actually had a Brian Buffini market, forecast thing earlier this afternoon that I ended up listening to. And he started his predictions, and he started off the podcast, was recording, with a CBC news segment where, and this was probably back in the 70s, excuse me,
this is gonna be interesting.
Where the presenter was saying mortgage rates are now at 70.08% and yada, yada, yada. And then there was a real estate agent they were interviewing and what's your thoughts on where rates are going to go? And one of the questions the real estate agent was, do you think that rates will ever, get down to 10, 11, 12%? And she's like, no, probably not in our lifetime. So his point on that is that, markets change, so I really can't talk to that. But what I can say, Joe, is that some of the prevailing discussion right now, remember we said about 25-year, our norm was around 5%.
Yeah.
The new conversation, given this long trough of low, is that, will 4 maybe now be our new norm? Are we going to, we talked about, back in, the 2015, 16, kind of prices being around 3.69, 4.79. Is that kind of now our new norm?
Right.
Do you know what I mean?
I know.
So again, it's all conjecture, but it's people speculating and also looking back on where we've been and what's reasonable to happen.
Yeah.
And also to engaging, economists from especially, major banks.
There's so much
wealth of information. But again, crystal balls are analyzing data, but
Yeah.
Stuff happens, right?
I know. I feel like no crystal ball here, but I do feel like interest will come down and we'll see it go down, not to where it was before.
Sure.
Yeah, because where are we at right now? 5.4, you said, or whatever?
Yeah.
I think that we'll probably see it with a 4. This is me too. And that we'll probably see it there for a while and maybe fluctuating
Right.
within a percent or so, because like what we've seen with, to me, the interest going up so much so quickly, like that nobody wants a market that's that volatile.
Out of sync. No.
Yeah, like I think I could be wrong that a lot of people up high and everywhere benefit from a balanced market. I think that there's people that are able to pull levers that do benefit from the market getting volatile. Like there's always going to be people, but I think balance is good for a lot of things. And I think that we'll see that for a while because clearly they did this. I have to hope to try and correct where it was going.
Right.
And they had to make some big changes quickly because...
Especially in major markets, right?
Yeah, like why else would you do that? Like the goal, I don't think, is to collapse everything. And like they've clearly stopped because like if they wanted it to shut down, they could have kept going.
Sure.
Right? We would, which I've heard that it happened in like the 80s or something where the interest went from like whatever to like 18% almost overnight or something. I don't know.
Crazy.
If you've heard about that. I talked to some of these farmers around here where they told me like things just like on a dime turn, but I've never dug into that. But I asked the question about being higher because I don't see it in the foreseeable future in the next maybe 5 or 10 years where like it could be 10% interest, but
right.
I
haven't heard that discussion. I haven't had the discussion at all.
No, me neither, but I can't eliminate the idea of that at some point it could happen because like we've seen a lot of things that we didn't think would happen. Like I still remember while the market was on fire, every day waking up and going into houses being like, what is going on?
Right.
I was in this a house exactly like this 2 weeks ago and it was worth way less than this. And just being like, I don't know what's going on. I don't know what's going on.
Yeah.
And then like that just becoming the norm.
That's crazy though.
And then
the
like,
short-term norm, right?
Yeah. And then like at some point when we hit the peak in prices coming down and just being like, this is what's happening and like getting used to it. And now like we've gone through these ebbs and flows and it's been a wild ride. Yeah. We've been living through some wild stuff in our careers.
Sure. Yeah. No, for sure. Yeah. But and I think, that really, I think there's a learning opportunity as well. I know from a business perspective, I think that it really stresses the fact that you need to kind of really save for a rainy day. You need to understand that when the market's high and like you're swimming in cash, et cetera, are you strategic, with what you're doing with that? And are you aware of the fact that all markets are cyclical and, you can't, we've had a lot of people exit the mortgage broker space. I'm sure you guys see the real estate space as well.
For sure.
Because of the market reality, right?
Yeah.
And just back to your point about interest rates, on the fixed side of business, there's a few indicators out there that kind of will give people a general idea of kind of where interest rates are going. One of the big things is the price of gas. Mm-hmm. When you see kind of gas being higher, you're probably going to find that interest rates are higher as well. Mm-hmm. Okay.
Gas has been at a price decent now.
It's been coming lower, right? And so I just told you about these whisper specials, off the books type thing. Do you know what I mean?
Yeah.
And then so the other thing too is that supply chain. Okay. Mm-hmm. So supply chain is a really big market indicator of what the economy is doing. And again, they're not directly linear to mortgage rates, but there's all these market factors that affect interest rates. But those are a couple of things. If you're hearing supply chain, lags, et cetera, you may find that interest rates are fixed interest rates are on the higher side as well. And then the third thing too is the employment. Like what does the opportunity for employment look like? And those numbers also, so those are the three big things. Yeah.
What were they again? I'm going to jot those down.
So gas prices, so consumer goods basically. But gas is a really big one that we drive by. Supply chain. And also, what are the unemployment numbers like?
Would that be employment or unemployment or either or really?
Pick it.
Yeah, gotcha.
Unemployment. If unemployment's high,
yeah,
it's probably a good indicator to the market.
Can you believe we've been talking for an hour and a half already?
Really?
Yeah.
Time flies. You're having fun.
No doubt.
And no alcohol either. Just water.
I know. I have some fun questions.
Sure.
And one thing that I want to touch on, but is there anything you want to talk about before I kind of?
I think I'm good.
Yeah.
Yep.
So just the last big thing I kind of want to touch on that I just jotted on because I don't do a lot of prep for these. But how do you think that AI will be affecting your industry in different ways?
Well, so from a marketing perspective, I mean, I've actually done. I'm on ChatGPT big time. Okay?
Yeah, I can see that.
I have right from day one. I was an early adopter, and I've actually done 8 or 9 training sessions for real estate teams, mortgage teams, webinars on utilizing AI and how we integrate that into, what we're doing to be able to put information out there. I love it.
Nice.
I'm actually doing one for an online real estate auction convention in February that's being held in Niagara. I'm going to be doing a session for them on that.
Interesting.
And then, I have a bot on my website, and basically what happens, Joe, is that it learns the collective knowledge of everything on my website, blogs, et cetera, et cetera. Mm-hmm. So somebody gets on and they type a question, it utilizes my website content as a knowledge base for bringing a response.
Wow.
Hey, can I book a time with Steve? Absolutely. It pops up my link right away. I didn't get to program any of it. Artificial intelligence recognizes all of that and gives you a return, an output that gives you some really, and it's kind of super slick and cool. Okay,
that sounds pretty cool.
And then so there's a lot of also discussion about brokerages integrating, on a national level, artificial intelligence to be able to help people do their jobs faster.
Right.
Yeah. But I love like the bot style chat thing. I mean, I think it's fantastic. I'm using all the time. I use it for webinar outlines. I use it for speakers notes. I mean, it's like I use it for blogs. I use it for a ton of stuff. Huge fan. And really, let me put this out there, okay?
Yeah.
It's going to do the heavy lifting for you. You need to check the content to make sure it's reasonable, et cetera, et cetera. Okay.
Totally.
And you really can't just, hit enter and then just go ahead and publish it. Okay.
Yeah.
But it's going to do 85% of the heavy lifting for you.
Wow.
You still need to take a look at, you still need to work, you still check it, et cetera, et cetera. But I think it's a huge time saver. I utilize it for, let's say, for example, I get news feeds coming through on the real estate and the mortgage space. If I see an article that I really like, I'll actually copy it. I'll put it into AI, and I said, please give me, a database letter to my clients, that is focused on this. Do it at a friendly, approachable manner at a grade 8 reading level, because that's how people, regardless of education level, digest information easily. Okay.
I'm more maybe grade 4 level.
There you go.
So maybe
finger painting
that down. Yeah.
But yeah, so and it gives stuff that is has great tonality to it. It's easy to digest, and I stick it out there because I'm not a rocket scientist. I don't have time to go through and create all this original content, but I can piggyback, because got news for you, buddy. There are no more original ideas anymore.
No.
Everything is reverse engineered.
Yeah,
okay.
Totally.
So I think there's a really great way for business people, entrepreneurs like us, to utilize technology to kind of make our lives easier, but still provide value to our audiences.
Totally. And with that being said, and you leaning into it, I think it's great. What about the fear of AI replacing what we do?
I'm not so sure that that any technology is ever going to replace people to a degree. I think what's going to happen is that maybe people's jobs don't look exactly the way they are now. Mm-hmm. That'll change, but I think opportunities will come as a result of that. So maybe your goals, your responsibilities change slightly and evolve in line with the evolution of our. But I don't think anything is really going to replace people.
Yeah, interesting. Yeah. I don't know. We'll have to wait and see, because I see there's opportunities for AI to definitely let me go from the real estate side. Mm-hmm. I think that the people that create value and solve problems and are really good at what they do will always have a spot to do things.
Sure.
But the people that are not as good at creating value, I think that there's an opportunity for AI to do things better.
Yeah.
So,
but that's like that now.
For sure.
So if you think about it, even without in the absence of AI, those people that are just getting by are not really going to have robust, full, careers, businesses, etc. So I think that's really going to change that. And to that point, who's not going to want to talk on the phone with you? Yeah. Who's not going to want to pick up the phone or whatever, have some form of communication with you and know they have Joe and you're giving them the straight goods. I don't think nothing's going to replace that.
Not for everybody. Mm-hmm. Yeah. Okay. This was fun. I have some fun, just off topic questions I'll throw at you. The one I've been asking everybody is, if you are on death row, I hope it never happens. What would your last meal be?
Spaghetti and meatballs.
Yeah?
I'm a huge fan.
Oh yeah. Made by who? Anybody specifically?
So my wife knocks out of the park. She makes her own meatballs and she makes her own sauce, and it's pretty tasty stuff.
I like it.
That's my favorite.
What would you have to drink with that?
Probably a red wine. That's my favorite. Combo. Yep.
Anything else to go along with that meal? I mean,
probably my wife's carrot cake. It's off the hook, fantastic.
Yeah.
Oh yeah.
That sounds good.
It's really good.
I like that. Was a pretty good one. I think you're the first one maybe to say spaghetti and meatballs. That's a good one.
Yeah.
What do you like on your pizza? I can't believe I went this long without talking about pizza.
I know. I like pizza too. Yeah. So you know what? I'm pretty straightforward. I mean, typically we kind of do the whole Hawaiian approach. We'll do like pepperoni, mushroom, pineapple. I love green olives as well. Not a big fan of black olives. On my black olive choice is definitely the Kalamata olives.
Yeah,
I don't like kind of the black, kind of waxy ones. They're not flavorful for me. But I love the flavor that green olives also add, especially to when you cook with them.
Oh, yeah.
I think it's awesome.
I'm a big olive fan. So
pepperoni, mushroom, pineapple, green olives.
No hot peppers.
I'm okay with that. I wouldn't shy away from it, but normally we wouldn't order that as a go-to. But if it were on it and I'd dive in, no problem.
Yeah. Yeah. Interesting, because I like that combo. I would eat that all day. But the one fear I would have with that much stuff on the pizza is that it could be undercooked, because there's a lot of moisture content in the pineapple.
We also ask for crispy crust. Like we kind of like that anyway. Yeah. Nothing worse than picking it up and have it fall off. And that kind of ruins the experience, right?
Yeah, because if the pizza place is cooking the pizza like a cheese pepperoni pizza amount of time with pineapple and green olives with all that moisture, you're going to get a sloppy mess. Yeah. But if it's cooked well, that's key.
Well, we asked for that specifically.
Yeah,
because you experience what you just said, and we're not fans of that.
Makes sense. Favorite kind of music or era of music?
80s, dude.
Yeah.
Oh yeah, 100% for sure. I pity people that don't know 80s music. And what's interesting to me is that, we play it all the time whenever we can. If we have a couple drinks or the family over, playing cards, whatever we're doing, okay, out come the 80s. If dad's drinking, it's 80s music.
Yeah.
Right? And then so what's interesting is that I noticed we have twin daughters and we have a son as well, but in particular, our daughters would start singing along to the words. And I'm just like, how do you know this song? Right? Or the other thing that I love is when a quote unquote new song comes on and they're using an 80s backbeat. Awesome. And I'm just, and I'll know the melody, and the kids look at me and say, how do you know that? I'm like, please.
Remake, baby.
Please.
So some 80s bands that come to mind.
So we went and we saw Journey, big fan. Okay. We saw Genesis for the Abacab tour. We saw Rolling Stones. Oh my God. Fantastic. Just amazing. Yeah. Nice. So yeah.
I like it. This one's a little bit deeper, but I like this one too. Meaning of life.
Meaning of life. You know what is family? Be a good person. Work hard and enjoy life.
Yeah, I like that.
Because we're not here forever.
I like that. Okay, well, I don't even have this one down, but align with that. How would you define success?
I think it's different for each person, but I think if you are aligning your success measurements in line with your meaning of life, how can you go wrong?
Yeah.
Totally. I mean, obviously we want a comfortable life. For me, we like to travel. We want to make sure that our family is okay, you know? Yeah.
I like it. Going with that, if you could travel anywhere.
Oh, so I traveled a lot, buddy.
Yeah. Is there anywhere you haven't been to that you want to go to?
So my bucket list for sure, I got to go to Paris one day.
You haven't done Paris?
I haven't done Paris. No, there's just something about that, you know, I want to see the museums. I want to kind of experience, you know, like, you know, the food, right?
The people are not super friendly there.
I've heard that, but I think I'm okay with that.
Yeah.
Yeah.
Don't go there looking to meet your next best friend.
No. It would be something that my wife and I would do, and we go for and I wouldn't want to stay there for a long time. We probably maybe 4 days, 3 nights, 4 days, kind of get in, do the tourist thing and just experience it, you know? And then my next big thing is I really want to do the Mediterranean. We had a cruise booked, but then the Ukraine, you know, conflict kind of come up, and we ended up kind of shelving that. But we were leaving out of Barcelona, and we were going over to Italy and France and all that stuff. So we're going to get that back on the list of things to do, which I'm sure we'll do in the next couple of years.
I like it. Best piece of advice you would give in general to someone? From
a business perspective, or just...
whatever.
Yeah,
These are kind of fun questions.
So I'm really big on, you know what, work hard, you know, and try and be as competent as you can, and don't just let life slide by.
Yeah,
you know, because before you know it, like it's done, or you look back and there's a big chunk of time that you quote unquote wasted. When you could have been working towards something. Yeah, I don't care what it is. You know, that's up to you.
Yeah, exactly.
Right, but whatever it is, do it well.
Yeah, I like that. I like that. These are good. Who played a big role in who you are today?
So I think my grandparents, like in particular, you know, my mom's parents. You know, we lived in the east end of Toronto, and I remember from a really young age, you know, hopping on the streetcar because we lived in the east end on Queen Street, and going to the end of the line where my grandparents lived in the east end, and meeting my grandfather, and just that whole experience of going to their place and sleeping over regularly. They were fantastic people and really wholesome and loving and you know, unfaltering, and it was a really great environment to be in. And I always think back fondly of that experience as an early child.
I like it.
Yeah.
Last question. If you won $1 billion,
right,
what would you do?
Kind of what I'm doing now. We definitely live in Niagara. I have a bit of a custom home built, you know, probably with a water view. And I do more of what we're doing now. I probably wouldn't be a mortgage broker, but I would definitely be a private lender. Yeah. I put my money out there in the real estate space. I love the market. I put it out there, you know, obviously with a financial planner, et cetera, and I would make opportunities for real estate in the Niagara region.
I like it.
That's what I would do.
This was amazing.
It wouldn't even need to be $1 billion, Joe.
No.
Yeah, if it was one of those 70 million, you know, like lotto things, then that would be cool.
Good enough.
Yeah.
This was awesome.
Thank you, sir. I appreciate your time.
Thank you. Thanks for having me. People want to find you, where do they find
just go to the website, themortgageguy.niagara.com, and you can book a consultation. Top right-hand corner, you have access to my calendar. Book a time. Let me know what you want to talk about. I'll give you a call. I can set up a Zoom. I'm really big on you know, Zoom. I like that face-to-face, even though it's electronic, because you get to know people, build rapport, right? Because I think we gravitate people towards us based on our vibe.
Yeah, totally.
You know what I mean?
Totally.
And so it's nice to have that conversation and kind of understand where people are coming from.
TheMortgageGuyNiagara.com.
TheMortgageGuyNiagara.com.
This was awesome.
Awesome. Thank you, sir.
Thank you.